Welcome to Talk Tickers.
Great to be here.
So normally we are a professional earnings call summarization show, right? Like tearing into quarterly reports and forward guidance.
Right, the usual corporate plumbing.
Exactly. But on this deep dive, we are covering an incredibly important financial topic that dictates the actual plumbing of every single earnings report we analyze.
It really is the foundation of it all.
Yeah. And I want you, the listener, to just think about this for a second. You expect to feel the familiar texture of a paper bill, right? Maybe the cold edge of a coin in your pocket.
There's a very tangible certainty to physical cash.
There really is.
Yeah.
You hand that physical paper over for a coffee, the transaction is final, absolute, and it leaves zero data trail.
None at all.
But what if you woke up tomorrow and that physical cash was simply gone? Like replaced entirely by data on a screen.
Well, I mean, that transition is happening so aggressively right now. Over the last 5 years alone, global physical cash usage has dropped by 20 percentage points.
Wait, 20%, that's huge.
It's massive. We are witnessing this sudden vacuum in the financial ecosystem. And nature abhors a vacuum.
It does.
Yeah.
So to give you a summary of what we are unpacking today, this disappearance of physical cash has triggered a high-stakes war for control over the future of money itself.
It's a battle for the ledger, essentially.
Right. On one side, we have privately issued stablecoins, and on the other, sovereign central bank digital currencies, or CBDCs.
The two heavyweights.
We're going to dive deep into the mechanics of both systems. We'll explore the geopolitical fracture happening right now between the United States and the rest of the world.
And we'll get into the mind-bending cryptography being built to preserve human privacy, plus the macroeconomic earthquake this could trigger for traditional banks.
Yeah, we are tearing into the battle for the digital ledger today. Because whoever controls that ledger...
They control the rules of financial privacy, systemic economic risk, and international trade.
Exactly. This isn't just about upgrading from a magnetic stripe card to an Apple Pay tab.
No, not at all. This is a fundamental restructuring of what a dollar, a euro, or a yuan actually is at the base layer.
So let's establish the two contenders stepping into the ring here. In the private sector corner, we have the stablecoin.
Right. The market cap for fiat-backed tokens, things like Tether, USDC, BUSD, it ballooned to over $300 billion by late 2025.
$300 billion. That is serious liquidity.
And they run primarily on public permissionless blockchains. So to understand the power and really the risks of a stablecoin, we have to look at the nature of the liability.
Okay, unpack that for me. What do you mean by liability?
Well, a fiat-backed stablecoin is a private liability. It's pegged one-to-one to a national currency, usually the US dollar.
Got it.
Because they operate on networks like Ethereum or Solana, they're borderless, they settle instantly, 24/7, and they serve as the liquidity engine for decentralized finance.
Basically allowing capital to move at the speed of the internet. And here's the catch, right? I'm holding a private company's IOU. Like if I hold USDC, I'm completely trusting that the issuing entity actually has the US Treasury bills and cash sitting in a vault somewhere to back up that digital token on my phone.
Yeah, you are holding their counterparty risk. That is the crucial term here.
Counterparty risk.
Right. If that private issuer suffers a catastrophic bank run, or if the assets they hold in reserve become illiquid during a market panic, that token can break its peg to the dollar.
Which we've actually seen happen before.
We have. Now contrast that with a central bank digital currency. A CBDC is a direct digital liability of a central bank.
Which fundamentally alters the risk profile, right? Because when I check my traditional banking app right now, I see digital dollars. But those aren't actual dollars, are they?
No, they are commercial bank money. It's essentially an IOU from your bank generated through fractional reserve lending.
Right. You are touching on a distinction that I think most consumers never even consider.
Oh, absolutely. Your current bank deposit is a liability of a commercial entity. Sure, it's insured by the government up to a certain threshold.
The FDIC insurance?
Exactly. But a CBDC bypasses the commercial bank entirely. It is a direct claim on the sovereign government itself.
Wow. So I have an account directly with the Fed, essentially.
In theory, yes. And because a government backing its own currency in its own unit of account controls the money printer, it cannot default in the same way a private corporation can.
So it carries zero counterparty risk.
Zero. It is the safest form of digital money possible.
Okay, let me test a hypothesis here then. If stablecoins are already out in the wild, processing trillions of dollars in volume and facilitating massive global liquidity,
Which they are.
Why are 137 different governments, representing like 98% of global GDP, scrambling to build their own CBDCs? Are they just trying to regulate private innovation out of existence?
It's really about monetary sovereignty. Central banks exist to manage the macroeconomic steering wheel of a country.
Right. They adjust interest rates, control inflation.
Exactly. They stabilize employment and control the velocity of money. But if a private stablecoin becomes the dominant medium of exchange and the primary unit of account,
The central bank loses control.
the central bank's policy levers completely disconnect from the actual economy. They'd be turning a steering wheel that isn't attached to the tires.
That makes total sense. And a CBDC carries the status of legal tender too, right?
That's a huge point. Legal tender means a local merchant can put up a sign that says, "No Tether or USDC accepted here."
But legally, they could not refuse to settle a debt with a sovereign CBDC.
Precisely. The legal finality of physical cash is translated into a digital format. Governments absolutely require their national currency to remain the undisputed anchor of the economy.
But this friction, right, this fight between private innovation and sovereign control is actively forcing a massive geopolitical divergence, especially between the United States and its global competitors.
It is a stark divide.
Now, looking at the recent U.S. legislation, and I want to be incredibly clear here, our goal on Talk Tickers today is strictly to impartially analyze the mechanical and economic implications of these policies. We are not taking any political stance, left or right. We are just reporting on the facts of the source material.
Absolutely. Just breaking down the infrastructure.
Right. So looking at the U.S., the divergence is wild. We saw the U.S. House pass the Anti-CBDC Surveillance State Act,
which explicitly prohibits the Federal Reserve from issuing a retail CBDC directly to the public.
Yeah. And essentially at the exact same time, the Genius Act was signed into law, which creates a formal, regulated red carpet for private dollar-denominated stablecoins.
Assuming they meet strict reserve and licensing requirements, of course.
Right. So the U.S. posture is fascinating. They have formally rejected building a public, sovereign digital currency for retail use, and instead opted to weaponize heavily regulated private enterprise.
It's a completely contrarian bet compared to the rest of the world. I mean, look at the European Union deeply investing in the digital euro.
Or China.
Right. China is actively testing programmable features in its digital currency electronic payment project, the DCEP.
I really want to dig into those programmable features in China's DCEP because it highlights the stakes here. They aren't just testing digital transfers.
No, they're testing conditional logic embedded directly into the money itself.
Like transaction expiry dates. The idea that a digital yuan could be programmed to literally evaporate if you don't spend it by a certain date.
Yes, to stimulate local velocity of money.
That is an unprecedented level of macroeconomic control. Imagine your paycheck just disappearing if you try to save it.
Well, programmable money allows policymakers to execute surgical monetary interventions. Instead of lowering aggregate interest rates and just hoping commercial banks lend more.
A central bank could theoretically airdrop expiring funds directly to specific demographics or geographic regions.
Exactly. The economic power is immense. But the U.S. strategy of relying on private stablecoins introduces a completely different set of vulnerabilities.
Let's frame the U.S. approach like physical infrastructure, because I think that helps visualize it.
It's a great analogy.
The U.S. government is essentially saying, we aren't going to build the new digital highways. We will let private tech and finance consortiums lay the asphalt and build the stablecoin networks.
We will just enforce the federal safety rules, mandate the speed limits, and audit the toll booths.
Exactly. Meanwhile, the EU and China are building massive, state-owned, vertically integrated interstate systems.
Right. And the risk for the U.S. there is losing its influence over international technical standards. By ceding the architecture of the public rails to strategic competitors, the U.S. leaves a void.
And the Genius Act, while it creates domestic clarity, it also creates a blueprint for regulatory arbitrage, right?
That's the unintended consequence. It creates a defined perimeter that foreign entities can navigate.
How so? Like, if the U.S. is setting strict rules, wouldn't that keep bad actors out?
Well, consider massive foreign fintech companies that were previously hesitant to interact with U.S. markets due to regulatory ambiguity.
No.
With clear stablecoin legislation, these entities could establish operations in U.S.-friendly jurisdictions like Hong Kong or Singapore.
Which have their own accommodating stablecoin regimes.
Exactly. They comply with the U.S. framework from offshore utilize dollar-backed tokens to dominate global payment services, and simultaneously circumvent their own domestic capital controls.
Wow. So if I'm playing this out geopolitically, what happens to the dominance of the US dollar?
That is the trillion-dollar question.
Right now, the system relies heavily on the SWIFT messaging network and correspondent banking. That gives the U.S. incredible leverage to enforce financial sanctions.
Because the mechanics of traditional financial sanctions rely entirely on choke points.
Exactly. But if other nations establish interconnected CBDC networks that settle instantly on disparate ledgers without ever touching a U.S. correspondent bank, does the U.S. lose its primary financial weapon?
It's highly likely. When a transaction clears in dollars today, it typically requires a correspondent account at a U.S. institution. Sanctions work by legally prohibiting those U.S. institutions from processing the clearing data.
But if foreign nations develop interoperable CBDC bridges,
Right, where a digital euro can be swapped for a digital yuan instantly using atomic swaps on a distributed ledger.
the transaction never passes through that U.S. correspondent choke point.
Never. The U.S. is betting that the sheer liquidity and global trust in the dollar will ensure stablecoins keep the dollar dominant. But the mechanical enforcement of sanctions becomes exponentially more difficult when the underlying rails change.
So the U.S. banning retail CBDCs and leaning on stablecoins, I mean, that feels like a massive victory for privacy, right? At least the state isn't building a central database to track every time I buy a coffee.
Well, that assumes private corporations will not monetize or analyze your transaction metadata just as aggressively as a state actor might monitor it.
Oh, right. Surveillance capitalism.
Exactly. A private, permissioned stablecoin ledger, or even a public ledger where the on-ramps and off-ramps are controlled by regulated corporate exchanges, still subjects the user to intense surveillance.
Which brings us to the core conflict of this whole digital transition, the friction between absolute privacy and absolute accountability.
It's the ultimate trade-off.
Let's explore that friction. Physical cash is 100% anonymous. When I hand a $20 bill to a vendor at a farmer's market, there is zero digital footprint.
None. But transitioning to a purely digital architecture inherently creates a data trail.
And from an international human rights perspective, this is a massive issue.
It is. Article 17 of the International Covenant on Civil and Political Rights protects individuals against arbitrary interference with their privacy.
Right. The legal argument is centered on the principles of proportionality and the least intrusive instrument.
Exactly. Governments mandate anti-money laundering, or AML, and countering the financing of terrorism, CFT protocols.
And to enforce those, financial institutions have to perform know your customer checks.
Right. But applying a sledgehammer of total surveillance to every microscopic transaction in a cashless society just to catch a fraction of illicit activity.
It violates that proportionality standard under international law.
It does. And the architecture of the CBDC itself dictates how that surveillance functions. We basically have two models, account-based and token-based.
Let's break down the plumbing of those. An account-based system is basically a mirror of traditional banking, right?
Yeah.
Just centralized at the Federal Reserve or the ECB.
Exactly. In an account-based architecture, the ledger is tied directly to user identity.
So the central bank, or some delegated intermediary, has to verify my identity and my balance before authorizing the update to the ledger.
Right. Every transfer requires an authorization check against a central database. It inherently creates an unprecedented accumulation of highly sensitive centralized data.
And what about a token-based system? I know it uses distributed ledger technology, but how does it change that identity requirement?
A token-based CBDC operates much closer to a digital bearer instrument. It utilizes an unspent transaction output model, or UTXO, which is actually similar to how Bitcoin functions.
Okay, so how does that protect privacy?
The system does not need to verify the identity of the person holding the token. It uses cryptography to verify the legitimacy and the chain of custody of the token itself.
Oh, I see. The network verifies the object, not the user.
Exactly.
Okay, I have to play devil's advocate here, though. If we design a token-based digital currency that is completely untraceable, functioning exactly like physical cash on a peer-to-peer network,
Yeah.
aren't we just handing a frictionless, light-speed superhighway to money launderers and tax evaders? I mean, how can a regulator possibly allow that to exist?
Well, regulators are acutely aware of that vector, which is why the European Central Bank has been modeling scenarios for the digital euro to try and find a middle ground.
Right.
They outline a baseline scenario which enforces full transparency to financial intermediaries for all AML and CFT compliance, essentially maintaining the status quo of current digital payments.
But they're also actively exploring models of selective privacy.
Yes, selective privacy, meaning threshold-based tracking.
Okay, threshold-based tracking. So how does that work in practice?
Under a selective privacy model, offline, low-value proximity payments would enjoy a high degree of anonymity, mimicking physical cash.
Proximity payments. Imagine tapping two smartphones together to pay for a meal without an internet connection.
Exactly. However, the moment a user initiates a high-value transfer or aggregates transactions above a specific regulatory threshold.
The protocol automatically triggers standard identity checks and AML routing.
Right. It forces the transaction out of the shadows.
It's a pragmatic compromise. You get privacy for a newspaper, but you get tracked if you buy a car.
That's a good way to put it.
But what if we didn't have to compromise at all? This is where this deep dive gets incredibly fascinating to me. Let's look at the cutting-edge cryptography being tested right now by the Bank for International Settlements, or the BIS.
Project Tourbillon.
Yes. They are running experiments that prove technology might allow us to have absolute security and absolute privacy simultaneously.
The mandate of Project Tourbillon is to reconcile three seemingly incompatible goals in a CBDC architecture: security against double spending, high throughput scalability, and a cryptographic concept defined as payer anonymity.
Payer anonymity. Okay, let me work through the logic here. If I buy that coffee using payer anonymity, the barista's bank records the incoming funds to satisfy their tax and AML requirements.
Right, the merchant side is totally transparent.
And the central bank validates that a legitimate unit of currency changed hands. But absolutely no one, not the merchant, not the commercial bank, and not the central bank, knows that I was the originator of the payment.
Exactly. It's a one-way mirror for financial data. The payee's income is transparent to the necessary authorities, ensuring compliance on the receiving end.
While the payer's identity is mathematically decoupled from the transaction. Yes. And to accomplish this, Project Tourbillon deploys an architecture built around blind signatures, which is a cryptographic protocol first conceptualized by David Chaum.
The analogy for blind signatures is brilliant. It's the notary and the carbon paper.
I love this analogy.
Right. Imagine you have a highly sensitive document that requires an official notary stamp, but you cannot allow the notary to read the contents of the document.
Because it's private.
Exactly. So you place the document inside an envelope and you slip a piece of carbon paper inside directly above the document. You seal it and you hand it to the notary.
And the notary presses their official embossing stamp onto the exterior of the sealed envelope.
Right. The physical pressure of the stamp transfers the ink from the carbon paper onto the hidden document inside.
So the notary has officially applied their signature, validating the document without ever seeing the information it contains.
It's so elegant. But how does that carbon paper analogy actually translate into the digital mathematics of a CBDC application on, say, my smartphone? It relies on advanced public key cryptography. When you request a withdrawal of digital cash, your smartphone generates a digital token with a unique serial number.
Okay.
Before transmitting this token to the central bank for validation, your app multiplies the token's serial number by a random blinding factor.
It effectively obfuscates the data, putting it in the digital envelope.
Exactly. So the central bank receives a string of cryptographic gibberish.
The blinded payload.
Right. The central bank verifies that your commercial bank account has sufficient funds, debits the account, and then applies its private cryptographic key to sign the blinded payload.
This signature turns the data into valid legal tender.
Yes. Then, the central bank transmits the signed, blinded data back to your device.
And then my app opens the envelope.
Your application divides out the original blinding factor. You now possess a legally valid CBDC token, cryptographically signed by the central bank.
But the central bank has absolutely no record of the token's serial number.
None at all. They cannot link the token you hold to the withdrawal request you made.
That is mathematical magic. I mean, wow. But Project Tourbillon took it further, comparing two different structural designs for this, eCash 1.0 and eCash 2.0.
They did. And we need to break down the first iteration because it reveals a massive existential threat to digital money.
Okay, let's get into eCash 1.0.
In the eCash 1.0 architecture, the system must solve the double spending problem.
Which is basically preventing me from copying the digital token and spending it twice, right?
Exactly. Because the central bank didn't see the serial number when they signed it, they have to maintain a spent coins list.
Okay.
When you transfer the token to a merchant, the merchant routes it to the central bank. The central bank verifies its cryptographic signature to ensure it's not counterfeit, and then checks the serial number against the spent coins list.
If a number isn't on the list, the transaction is cleared, and the serial number is permanently added to the ledger so it cannot be used again.
That's the mechanism. It seems incredibly efficient.
But there is a vulnerability. And it involves quantum computing, doesn't it?
The threat model of a sufficiently powerful quantum computer running Shor's algorithm specifically is severe.
What happens?
If a quantum computer successfully factors the large prime numbers underlying the central bank's public key cryptography, a bad actor could extract the central bank's private signing key.
The master key.
Right. With that key, a counterfeiter could mint an infinite supply of perfectly valid CBDC tokens.
Oh my God.
And under the eCash 1.0 architecture, because the central bank only tracks spent coins, they would have absolutely no way of differentiating between a legitimately issued token and a quantum forged token.
Provided the forged serial number hadn't been spent yet.
Exactly. The entire monetary supply would be compromised instantly.
Which is absolutely terrifying. So how does the eCash 2.0 upgrade defend against a quantum counterfeiter?
eCash 2.0 completely reverses the tracking mechanism. Instead of a spent coins list, the central bank maintains an unspent coins list.
Okay, so it's populated at issuance instead of when it's spent?
Precisely. Populated at the exact moment of issuance. When your app requests the blinded signature, the central bank records the blinded identifier onto the unspent list.
Got it.
When you spend the coin later, the central bank verifies that the specific unblinded token mathematically correlates to an entry on the unspent list.
So if a quantum counterfeiter mints fake tokens, the transaction will just fail.
Right, because those forged tokens were never registered on the central bank's unspent ledger during issuance.
Thus, hold on, I see a flaw in the privacy there, though. If the central bank is recording the identifier onto an unspent list at the exact millisecond, my specific IP address requests the withdrawal?
Yep.
Couldn't they just run a timing analysis? Like they match the timestamp of my network request to the time the coin was registered, and the anonymity is completely broken.
You've identified the exact vulnerability of the unspent list model.
So how do they fix it?
To neutralize timing analysis and IP tracking, the BIS integrates a mix network into the withdrawal process. A mix network is a cryptographic routing protocol that acts as an intermediary between the user and the central bank.
The analogy of players sitting around a poker table, secretly shuffling a deck of cards comes to mind here.
That is an excellent visualization. Imagine your blinded token withdrawal request is a single playing card.
Okay.
You transmit it to an independent server node, the first player. That node collects withdrawal requests from thousands of different users, holds them temporarily, and shuffles the order cryptographically.
And then it passes it on.
It transmits the entire batch to a second independent node, which performs another layer of cryptographic shuffling.
And this happens across multiple nodes before it ever hits the central bank.
Exactly. By the time the batch of requests reaches the central bank for signature, the chronological order and network origins have been completely randomized.
So as long as just one single node in that mixed network operates honestly and deletes its routing metadata, it is mathematically impossible for the central bank or any surveillance entity to link the incoming coin registration back to your original IP address.
Mathematically impossible.
Incredible. So we have blind signatures securing the value transfer and mixed networks destroying the network metadata. But I know Project Tourbillon also relies heavily on zero-knowledge proofs, or ZKPs.
Things like Zscaler snarks and bulletproofs.
Right. Let's explain the mechanism of a ZKP, because it sounds like a paradox. How do I prove to a network that I have enough money to buy something without actually showing the network my account balance?
The mechanism of a zero-knowledge proof is profound. It allows a prover to demonstrate to a verifier that a specific computational statement is true without revealing any underlying data that makes it true.
It's hard to wrap your head around.
To visualize this, consider the classic Alibaba cave analogy. Imagine a circular cave with a locked door blocking the path at the very back.
Okay, I'm picturing it.
You want to prove to me that you know the secret passcode to unlock that door, but you refuse to tell me the passcode itself.
Okay, so I walk into the cave, and I can choose to go down either the left path or the right path. And you wait outside where you can't see me.
Right, I wait outside. Then I walk to the entrance of the cave and shout a random instruction, come out of the left path, or Come out of the right path.
If I don't know the passcode to the locked door at the back, I only have a 50% chance of being on the correct side to fulfill your request.
Exactly. But if we repeat this process 20 times, and every single time you successfully emerge from the path I randomly call out, the statistical probability that you are just guessing approaches 0.
Because the only way I could always emerge from the correct path, regardless of which side I started on, is if I possess the passcode to open the door and cross over at the back in the cave.
Precisely.
I've proven I know the code without ever saying the code out loud.
That is the absolute essence of a ZKP.
So how does that work for digital currency?
In a network using ZK SNARKs, which stands for Zero Knowledge Succinct Non-Interactive Argument of Knowledge, your digital wallet performs complex polynomial equations off-chain.
It generates a cryptographic proof that your token is valid, unspent, and belongs to your private key.
And the network nodes verify the mathematical validity of the proof itself, which is computationally lightweight without ever needing to see the token's serial number, the transaction amount, or the user's identity.
And crucially, all of this data is wrapped in quantum-safe cryptography to defend against harvest now, decrypt later attacks, right?
Yes. Hackers are currently scraping encrypted transaction data, simply hoarding it on massive servers.
Just waiting for the day a quantum computer comes online to crack the encryption retroactively.
Exactly. Quantum-safe algorithms use lattice-based cryptography to ensure that even a future supercomputer can't break the math.
The synthesis of these technologies in Project Tourbillon is just, it demonstrates that absolute privacy and systemic security are not mutually exclusive.
Not at all. The cryptographic tools exist to build a network that prevents double spending, enforces merchant-side AML compliance, and maintains the pristine anonymity of physical cash for the consumer.
It's amazing. But let's pull back from the theoretical cryptography for a minute and look at the actual reality of the infrastructure being built right now.
The boots on the ground, so to speak.
Right, because the global financial system is not going to adopt a single, unified, mathematically perfect CBDC.
No, it's going to be incredibly messy.
As we covered, the U.S. is heavily backing private stablecoins on public blockchains like Solana. The EU is building a highly structured digital euro. Traditional banks are building private, permission ledgers for wholesale interbank transfers.
We are accelerating toward a deeply fragmented, hybrid financial future.
So how do these isolated silos communicate? If a private wholesale CBDC exists on an institutional ledger and a fiat-backed stablecoin exists on a public Ethereum network, they operate on entirely different consensus mechanisms, right?
They do. They utilize different smart contract languages. Without an orchestration layer, capital becomes trapped in disparate walled gardens, which drastically reduces the velocity of money.
And this is where we have to look at interoperability standards, specifically protocols like the Chainlink Cross-Chain Interoperability Protocol, or CCIP, and the Chainlink Runtime Environment.
These networks act as the connective tissue of the new economy.
They function as a universal abstraction layer. Let's examine a specific workflow known as delivery versus payment, or DVP.
DVP is a great example. In traditional finance, settling a complex asset swap involves multiple intermediaries, clearinghouses, and days of settlement latency.
Which introduces significant counterparty risk. Let's use a tangible example to ground this. Say a localized commercial bank wants to purchase a tokenized U.S. Treasury bond that currently resides on the public Ethereum blockchain.
Okay.
But the bank's internal compliance requires the payment leg of the transaction to be settled using their internal, highly secure wholesale CBDC on a private subnet.
So they need to swap assets across two totally different architectural dimensions.
Right. Without a protocol like CCIP, the bank would have to manually transfer funds, rely on an escrow service, and just trust that the tokenized asset will actually be delivered after the payment clears.
It's slow and risky. But CCIP utilizes decentralized oracle networks, or DONs, to orchestrate the swap.
How does that work?
The protocol locks the required CBDC payment on the private ledger. Simultaneously, independent node operators observe the public Ethereum ledger to verify the tokenized treasury bond is valid and locked.
Wait, how do those nodes agree that the data is accurate without a central authority dictating the truth?
That's the brilliance of it.
Yeah.
The node operators perform independent computations and use a cryptographic consensus mechanism.
Okay.
Only when a supermajority of independent nodes mathematically agree on the state of both ledgers does the protocol generate a cryptographic proof.
And then CCIP executes the swap atomically.
Exactly. The wholesale CBDC is transferred to the seller on the private chain, and the tokenized bond is transferred to the buyer on the public chain at the exact same computational moment.
Delivery and payment are inextricably linked. There is no latency.
None. But the interoperability isn't just about moving the tokens. It's also about the off-chain data that dictates how programmable money behaves.
Right, because if a smart contract is programmed to automatically execute a tax payment or release collateral when an asset hits a certain price, the contract itself is blind.
Smart contracts are strictly deterministic logic. They only know what is on the ledger. They cannot see the outside world.
Which is why Oracle networks are critical. They aggregate real-world data, market prices, weather data, identity verification, and push it on-chain in a highly secure, decentralized manner.
And this ties directly back to our very first point today about stablecoin counterparty risk.
Because if I hold USDC, I need to know the actual US dollars are sitting in a regulated bank vault off-chain.
Right. And interoperability networks provide a mechanism called proof of reserve.
Proof of reserve, how does that monitor the banks?
Proof of reserve utilizes decentralized Oracle networks to continuously monitor the off-chain balance accounts of the stablecoin issuer.
So they are constantly pinging the API of the physical bank.
Yes. The oracles verify the fiat balances and publish that cryptographic truth directly onto the blockchain. The smart contracts managing the stablecoin can read this data in real time.
So if the off-chain reserves ever fall below the required 1-to-1 backing ratio,
the smart contract can be programmed to automatically halt the minting of new tokens. It mitigates systemic risk before a bank run can even fully materialize.
connectivity really is the absolute baseline requirement for this new financial stack.
It is the lifeblood.
But as we rebuild the plumbing of money to be this fast, this verifiable, and this perfectly collateralized, we run into a macroeconomic earthquake.
The narrow banking debate.
Yes, discussed in the New York Fed research. This fundamentally challenges how economic growth is actually funded in this country.
To grasp the magnitude of the narrow banking debate, we have to look through the lens of the new monetarist model.
Specifically, the framework pioneered by economists Lagos and Wright, which analyzes the frictions of trade and how liquidity functions in decentralized markets.
Right. Let's ground this in how the world currently works, just to set the baseline.
Okay, say a local construction company needs a $5 million loan to build a new housing development. They go to a commercial bank.
And that bank has the capital to lend because thousands of everyday consumers deposit their paychecks into checking accounts.
Right. The bank performs fractional reserve lending. They keep a small fraction of those deposits in reserve to handle daily withdrawals, and they lend the massive remainder out to the construction company.
The crucial dynamic there is the duration mismatch. The bank is borrowing short-term because depositors can withdraw their money at any second in lending long-term, like a 5-year construction loan.
Because the bank pays the depositor very little interest, those deposits serve as incredibly cheap funding.
Exactly. And that cheap funding allows the bank to offer affordable interest rates to the construction company, which drives localized economic growth and capital expenditure.
Okay, now, introduce a fully backed retail stablecoin or a synthetic CBDC. Let's say it's backed 100% by short-term U.S. Treasury bills held at the Federal Reserve.
It is mathematically and structurally immune to a bank run. It carries zero fractional reserve risk.
Right. So if consumers are presented with a digital dollar that yields a competitive interest rate, settles instantly, and carries zero risk of institutional failure.
Rational market behavior dictates a massive capital flight.
People will just pull their money out of the regular banks.
Consumers and corporate treasuries will pull their liquid capital out of traditional fractional reserve commercial banks and park it in these perfectly safe digital assets.
The digital assets essentially function as narrow banks. They take deposits, they hold perfectly safe collateral, but they do not issue loans.
Exactly. So what happens to the commercial bank in our scenario?
Well, the commercial bank suddenly experiences a severe contraction in their cheap deposit funding.
Right. And to maintain their balance sheet and satisfy regulatory capital requirements, the bank has to find funding elsewhere.
So they are forced to borrow from wholesale credit markets at much higher interest rates. Or they have to drastically raise the interest rates they offer on retail checking accounts to lure depositors back from the stablecoins.
Either way, the bank's cost of capital skyrockets, and they pass that cost directly onto the borrower.
A construction company.
The mechanism dictates that the bank must charge higher interest rates on loans to maintain their net interest margin.
So when that local construction company comes in for the $5 million loan, the interest rate is no longer 6%, it's 10%.
And at 10%, the housing development is no longer financially viable. The project is canceled, the jobs aren't created, and the velocity of the M2 money supply drastically slows down.
Wow. So systemic narrow banking, driven by perfectly safe digital tokens, could severely stifle the credit creation that powers modern economic growth.
That is the fear.
But the New York Fed research offers a counterweight to that doom scenario, right? The fractional reserve system isn't perfect.
Far from it. It carries an inherent risk-shifting incentive.
Because retail bank deposits are heavily insured by the government, meaning the taxpayer ultimately holds the bag. Commercial banks are sometimes incentivized to take reckless, highly leveraged bets with that cheap funding to maximize shareholder returns.
It is the classic moral hazard of privatizing the gains and socializing the losses. When commercial banks engage in excessive risk shifting, it leads to systemic fragility and catastrophic financial crises.
So the macroeconomic argument for embracing stablecoins is that migrating a massive portion of the public's transactional wealth out of highly leveraged commercial banks and into perfectly collateralized narrow banks fundamentally de-risks the global financial system.
Exactly. The probability of cascading bank runs practically evaporates.
So policymakers are staring down a brutally complex trade-off here.
They are.
Do they heavily restrict the proliferation of private stablecoins and retail CBDCs to protect the cheap deposit funding of commercial banks, ensuring the credit spigot stays wide open for businesses?
Or do they embrace the narrow banking model, accepting that loans might become more expensive in exchange for a digital financial system that is mathematically immune to collapse? It is the expansion of trade versus substitution of trade dilemma. As decentralized finance and crypto-based trade expand, regulators must constantly calculate whether the introduction of a new digital asset creates net new economic activity.
Or if it simply substitutes and drains liquidity from the traditional banking sector that supports the real economy.
Exactly. It's a massive balancing act.
We have dissected an immense amount of infrastructure today. To recap the core dynamics for our Talk Tickers audience, the physical cash in your wallet is rapidly becoming obsolete.
It's fading fast.
And in its wake, a foundational battle is raging between sovereign central banks and private corporate issuers for control of the digital ledger.
We explored the U.S. strategy of rejecting public retail CBDCs in favor of dominating through regulated dollar-backed stablecoins.
A move that outsources innovation but invites regulatory arbitrage and challenges the architecture of global sanctions.
We analyzed the technical realities of privacy, detailing how account-based surveillance systems contrast with token-based autonomy.
We unpack the cryptographic marvels of Project Tourbillon, demonstrating that tools like blind signatures, zero-knowledge proofs, and mixed networks offer a viable path to retaining cash-like anonymity without sacrificing systemic security or AML compliance.
And finally, we examined the profound macroeconomic threat of narrow banking, where perfectly safe digital money could inadvertently starve the traditional economy of vital credit.
Before we sign off, I want to leave you with one final provocative angle to consider. A concept that builds on the geopolitical and macroeconomic shifts we've discussed today.
It's a fascinating thought experiment.
We spend a lot of time analyzing the fears of state surveillance and the threat of quantum cryptography. But what happens if a private stablecoin issuer, completely embedded into the global financial plumbing via interoperability networks like CCIP, grows so massively successful that it inadvertently becomes a shadow central bank?
The data points to a scenario where a single private tech consortium holds more U.S. Treasury debt in its reserve vaults to back its circulating stablecoins than the sovereign reserves of multiple developed nations combined.
Which is wild to think about. When a private entity commands that level of treasury liquidity, their internal algorithms regarding yield, collateral, and token issuance begin to exert massive unfiltered influence on the actual yield curve of sovereign debt.
The throne of the global economy might not be empty for much longer.
But the entity sitting on it, dictating monetary policy, might not be an elected government. It might be a purely algorithmic, privately controlled smart contract.
It's an entirely new paradigm.
Thank you for joining us on this deep dive. Tomorrow morning, when you pull out your phone to tap for a coffee, consider the cryptographic war and the macroeconomic tectonic plates shifting beneath that single second of convenience.
The simple act of paying is being entirely rewritten.
We will see you on the next deep dive of Talk Tickers.